a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
We're going to talk about IPOs now. It's been an active market in the IPO market lately. Our ETF research director, Nina Mishra, is going to tell us exactly how that relates to ETFs. And there is a correlation there, which we'll see in just a moment. So earlier in the year, the IPO market started kind of lagged a little bit, started slow. But now it's really heated up.
Yes, you know, last week shares of this hot IPO, Fitbit, which is a wearable fitness device maker, they surged almost 50% on the first day of trading, even though the company had increased the size and the price range of its offering earlier. And the shares have continued to climb higher, which shows investors' strong appetite for these hot IPOs. And this week, 15 companies are expected to go public, according to D-Logic. And with that, June appears to be on track to be the busiest month for IPOs since 1999.
And this week, just so if people are following on the calendar, is the week of June 22nd, right?
Yes.
Okay.
So it seems that investors still believe that despite all the uncertainties relating to Greece and the Fed's rate hike, US stocks are still the best place to put your money in. But they are looking for better growth opportunities because the broader market returns are lackluster and they're expected to be lackluster this year.
But there are, in fact, IPO ETFs, you say?
Yes. You know, these IPOs investing in these, you know, new, rather unknown, high-risk companies, sometimes it is very rewarding, but sometimes it can result in huge losses also for the investors. So I think IPO ETF is a better way of getting exposure to this exciting corner of the market. And now as the IPO market is heating up, many companies which were waiting on sidelines earlier, they have started launching their offering as the economy is now clearly showing clear signs of rebounding after stalling in the first few months of the year. So this may be a good time to look at a couple of those IPO ETFs.
So everybody knows, who's been following the market for any length of time, that many times IPOs are not successful. They kind of fall apart.
Right.
So that's with the individual stocks. But when that happens, how is that reflected in an IPO ETF?
Like the first ETF that we are talking about, it waits for some time, and it includes only the, you know, the best performing, most liquid, and the largest IPOs. So the chances of you know, failure for this ETF are much lower than chances of failure when you are investing in a single company. The risk is much higher. So you better, when you hold 100 of these IPOs, you get a better diversification and lower risk, but you are still getting an exposure to the IPO market.
Okay, so the first one you're going to talk about is the First Trust US IPO Index. Now this is an index.
Index ETF. That's the name. It's the ticker is FPX. It was launched in 2006, and now it has almost 780 million in assets under management. It tracks the performance of 100 largest and best performing and most liquid US IPOs. Facebook, AbbVie, Kraft Foods are among the top holdings, and it charges an expense ratio, a fee of 60 basis points per year. This has been outperforming the broader market since its inception.
Interesting. Then there's the Renaissance IPO ETF.
Yes, the ticker is IPO. This is relatively new. It was launched in 2013, has about 29 million in assets under management. This also tracks the performance of largest and most liquid newly listed IPOs. Alibaba, Twitter, and Hilton are among the top holdings. Now, this IPO ETF can include newly listed company on as early as on the 5th day of trading itself, or during quarterly review, as opposed to the earlier ETF, which waits for some time. And another difference is that FPX, the earlier ETF we talked about, it also includes spin-offs. This ETF does not.
I see.
Expense ratio is the same, 60 basis points per year.
All right, so these IPO ETFs have been outperforming the broader market?
Yes. As I mentioned, the first one has been around since 2006, and it has since inception, it has been outperforming the broader market. And on this chart, I have the relative performance for this year, in fact, for the last 6 months. So we can see that both these IPO ETFs, FPX as well as IPO, have outperformed the broader market ETF. Represented by SPY here. But FPX, the First Trust IPO ETF, has done better than the Renaissance IPO ETF.
Okay, do you own any of these IPO ETFs?
I don't.
Boy, that's confusing. Thank you. Thank you for looking in on this little explanation of how IPOs are reflected in the ETF market. If you want more ETF information and you're not at our website watching this video, get on over to Zacks.com. You can get to the ETF section of Zacks.com by using the Funds tab at the top toolbar. With Nina, I'm Terry Ruffalo.